How does the Federal Reserve's stance on interest rates impact the economy? And what role does inflation play in these decisions? These are the questions we're exploring today as we navigate through the complex world of finance and economics. The current state of the economy is influenced heavily by the Federal Reserve's decisions on interest rates. These rates not only affect borrowing costs, but also play a crucial role in controlling inflation. Inflation, the rate at which the general level of prices for goods and services is rising, can significantly impact the economy's health. Enter Bill Ackman, the billionaire hedge fund manager, known for his sharp and often foresighted views on the economy. Ackman has been vocal about the Federal Reserve's role in managing interest rates and its impact on inflation. He has shared his insights, predictions, and warnings, shedding light on the possible economic trajectory. As we journey through this discussion, we'll be delving into Ackman's viewpoints, looking at how they have evolved over time, and what they mean for the economy's future. So, buckle up and get ready for an insightful exploration of economics and finance. Now let's delve into Ackman's predictions and how they have evolved over time. In mid-2022, Ackman made some bold predictions about the Federal Reserve's approach to combating inflation. Ackman, a billionaire hedge fund manager, confidently foretold that the Federal Reserve, under the leadership of Chairman Jerome Powell, would keep benchmark interest rates higher for a more extended period. Why? Well, Ackman saw inflation as the biggest threat lurking in the shadows, ready to pounce on the US economy. He expected Powell to not only maintain higher rates, but also be open to a terminal rate higher than 3.4%. At that time, the benchmark interest rate hovered between 1.50 to 1.75%. Now, you may be wondering, why would the Federal Reserve, whose primary job is to stimulate growth, focus on fighting inflation? Ackman argued that the very expectation of the Fed focusing solely on growth weakens its ability to combat inflation. This, he warned, could lead to further rate hikes. He also voiced concerns about the Fed's inflation target. Ackman posited that the current 2% target was no longer realistic. He attributed this to several factors, including deglobalization, the transition to renewable energy, rising wages, and shorter supply chains. These factors, he believed, would exert upward pressure on prices, making a 2% target unattainable. His suggestion? Embrace a 3% inflation target. He warned that forcing inflation down to 2% could cause the economy to shrink and unemployment to spike. Ackman's views were controversial, but as we'll see, he wasn't entirely off the mark. As 2022 progressed, Ackman's views evolved, reflecting the changing economic landscape. He began to argue that the Federal Reserve's inflation target of 2% was no longer realistic. Instead, Ackman suggested that a 3% inflation target would be more fitting in the face of several factors. These included the transition to renewable energy, deglobalization, wage increases, and shorter supply chains. All these factors, he believed, would exert an upward pressure on prices, thereby making the 2% target unattainable. Ackman warned of the repercussions if the Federal Reserve tried to force inflation down to 2%. He cautioned that such a move could cause the economy to shrink and unemployment to rise dramatically. He was not merely predicting a mild downturn, but a brutal recession. His argument was that a 3% inflation target would be more conducive to a strong economy and job growth in the long term. It's worth noting that during this time, inflation rates had soared to a 40-year high of 9.1% in June and remained above 7% in November. The Federal Reserve responded by hiking interest rates in an attempt to cool the economy. However, Ackman warned that this could risk dragging the US economy into a recession. His caution about stubborn price increases leading to higher long-term interest rates and impacting stock valuations echoed his earlier warnings. Ackman's warnings grew more urgent as the economy continued to change. He had a clear message: the Federal Reserve needed to adjust its strategies and expectations to match the realities of the economic landscape. A failure to do so, he warned, could have severe consequences. Now, let's look at Ackman's most recent views. As of October 2023, Bill Ackman, the CEO of Pershing Capital Management, has expressed his belief that the Federal Reserve is likely done hiking interest rates. This comes amidst a noticeable slowdown in the economy, a shift that has not gone unnoticed by this seasoned investor. In his analysis, Ackman brings attention to the fact that despite some cooling, inflation figures still reflect a 3.7% annual increase. This is a significant figure as it stands above the Federal Reserve's target. This is a clear indicator that inflation's impact on the economy is still very much a concern. However, Ackman's views extend beyond just inflation. He also anticipates further increases in bond yields as the market continues to price in high inflation. Specifically, he predicts a rally for the 30-year Treasury yield into the mid-5s, but does not foresee the 10-year yield rising significantly above 5%. But it's not just bond yields and inflation that capture Ackman's attention. He also issues a warning about the ongoing threat of high mortgage rates and credit card rates. These, he argues, could have a profound impact on the economy. This is particularly true for those who borrowed at lower fixed rates for shorter time horizons, as they could face significant financial strain. Ackman further observes the potential for defaults on office assets and the rising pressure on the regional banking system in the commercial real estate market. These factors, he suggests, could add further stress to an already strained economy. Ackman's current views reflect a cautious optimism, tempered by a warning about potential threats. We've covered a lot of ground today, so let's summarize the key points. We began with Bill Ackman's initial predictions. The billionaire hedge fund manager voiced his concerns about the Federal Reserve's handling of inflation, emphasizing that it's the most significant threat to our economy. He anticipated the Fed would maintain high interest rates to combat this inflation, and even suggested that it might exceed the predicted terminal rate of 3.4%. Ackman underscored the importance of the Fed's role in managing inflation, warning that focusing too much on stimulating growth could weaken its ability to keep inflation in check. As we moved forward, Ackman's views evolved alongside the changing economic landscape. He challenged the Fed's inflation target of 2%, arguing that it had become unrealistic due to various factors such as deglobalization, the shift to renewable energy, wage increases, and shorter supply chains. Ackman suggested a 3% inflation target as a more viable strategy for maintaining a robust economy and promoting job growth in the long term. He cautioned against forcing inflation down to 2%, warning that such a move could lead to economic contraction and a spike in unemployment. In his most recent insights, Ackman stated that the economy is starting to show signs of slowing down, leading him to believe that the Federal Reserve is likely done with hiking interest rates. However, he warned of the lingering effects of high inflation, with consumer prices still showing a 3.7% annual increase, surpassing the Fed's target. Ackman also highlighted the potential impact of rising bond yields and high mortgage and credit card rates on the economy. He expressed concern for those who had borrowed at lower fixed rates for shorter time horizons and noted the increasing pressure on the regional banking system in the commercial real estate market. As Ackman's views highlight, the economy's future is uncertain, but by staying informed, we can better navigate these turbulent times.